We believe 2023 will be a very positive year for bond markets in general and credit markets in particular. In summer, we pointed out that some leading indicators were pointing to a fall in inflation rates across main economies. We believe a lot of this view is now playing out. In the US, we had the peak in inflation around 9% in July. We are down to around 7.5%, and most leading indicators are pointing further south. So they're pointing to a further fall in inflation. In Europe, we are finally getting some stabilization in inflation. The process is somewhat delayed because gas prices peaked in August, but we believe that 2023 will see a lot of downside in Europe too. Overall, we think US inflation will fall to 5% in summer 2023, and in the same time span, European inflation will get to 7%. As a consequence, we think central banks will be much more cautious. Basically, we think 80% of the hikes have been done in 2022. The Fed is guiding for a 5% terminal rate. The ECB is guiding for around 3%, even if more implicitly. And we think those two levels are very reasonable. So we think in the first to second quarter of 2023, the Fed will get to 5%, the ECB will get to 3%, and the bond market will not need to price any further hikes. Finally, we think 2023 will be a year of economic slowdown. We don't think we will see a deep recession because US consumer wealth remains strong and the gas situation in Europe has improved meaningfully in the past few months. So overall, we are looking to around 0% growth in both US and Europe, which is a decent slowdown but not a deep recession. In China, we are seeing baby steps being taken for the reopening of the economy. Trade data are trailing really weak levels in the past few months, and at the same time, on the ground, there are clear signs of abandoning the zero-COVID policy which characterized the past 2 years. So this could be a meaningful upside surprise to global growth, in particular to Asia growth. In Ukraine, the situation looks quite stuck on the ground, but there have been some discussion of potential agreement and negotiation over the past 2 months. Also, Europe has basically sorted out the gas situation for 2022, at least until spring 2023, meaning that the incentive for Russia to be very aggressive is probably reduced compared to summer 2022. So overall, we have a situation in which we have some sort of slowdown in the global economy, but there are upside risks coming potentially from China and Russia. In this environment, we think bond markets and credit markets are probably going to benefit a lot. 2023 will be a year of slowdown in growth, disinflation, and stabilization in central bank interest rates. As a consequence, bond market, which have been severely punished in 2022, will probably be the main beneficiaries. Within global bonds, the asset classes which are more sensitive to US interest rates are likely to outperform. Quality bonds, such as investment grade, financial bonds, especially subordinated debt, and potentially even emerging markets, which had a rough couple of years and are probably under position.